August CPI data showed a continuing softening, while latest jobs reports signaled a cooling labor market. On the flip side, high wage gains could prove a thorn in the Fed's side as they debate additional rate hikes in the month ahead. So what can we expect from Fed Chair Jerome Powell at Jackson Hole on Friday? BlackRock Global Fixed Income Chief Investment Officer Rick Rieder joins us now with what he's watching. Rick, great to have you here in studio with us.
Thanks for having me.
Absolutely. So how much of what Fed Chair Jay Powell says will set the tone, not just for the rest of this year, but also for Fed policy going into 2024?
Yeah, it'll be interesting how detailed he gets. My sense is he's not going to get that detailed.
It was 8 minutes last year, by the way.
Right. And, hard to say, but my sense is he keeps it pretty brief and doesn't get into, it's going to talk about, will he touch on the structural dynamics impacting inflation in the economy, things like deglobalization, things like there's a lot of money that's been coursing its way through the system. So he'll talk about that. Will he give the markets a sense for the near-term trajectory of rates? I don't think so. But it'll be interesting to see whether he thinks that rates, that we're going to be in a higher rate threshold for a longer period of time. Does he touch on the fact that structurally there's some things at play? The amount of infrastructure spend we're seeing in the world, the amount of debt that's been that is being borrowed and will continue to be borrowed at the government level. So some of these things can keep rates higher for longer. It'll be interesting to see if he touches on that.
Do you think that is the base case here, that inflation and rates are going to be higher for longer?
So higher than they've been over the last decade or so. That being said,
it's hard for them not to be, considering how low things were.
Totally, and for all those structural reasons that I think are still at play. And by the way, I think you touched on unemployment. Listen, you are seeing some slack. You're seeing a bit of softening. That being said, you're still at a 3.5% unemployment rate, and with wages that are still above 4%. So I don't think there's enough people for the jobs still. And although it's slowing and slack is growing a bit, you still have a structurally, by the way, not just in the U.S., in other parts of the world as well. You look at all these union agreements that there's not enough people for all the jobs. So rates have to stay higher than they have. Listen, I think the Fed is going to, will they go one more 25 potentially? But I think we're basically at the end of this hiking cycle, and I think we should be. I mean, you look at, I know we're going to talk about it later. You look at some of the retailer dynamics, and all of a sudden people have gotten on the economy's in better shape, which I've always argued the U.S. economy will surprise people. But now I actually think it's moderating a little bit, and so I think the Fed can take its foot off the brake, as it were, just let these high rates marinate through the system for a bit of time.
Even as we continue to hear about a strong consumer, where are those areas of moderation that we're seeing?
You look at, including the reports today, you're seeing, the low end, and this is part of why I think the Fed should stop. In fact, I think they got to stop a while ago. You're creating this tremendous bifurcation in the economy. Obviously, it's been well chronicled, the pressure on the small banks, the regional banks, the pressure in commercial real estate. But you look at some of the data today and yesterday and the day before, it's the lower end of the income strata, it's the bottom 10% that is getting hurt. You look at, like today, you look at apparel, not just in today's data, but you look at what's happening to apparel. It's the lower end that's under some pressure. And then I've said before, when you lift rates like this, it's the lower end that are the borrowers. You look at credit card balances growing, and you actually benefit the high end. I just don't think it makes sense today because we have an economy that's not as interest rate sensitive generally, but there are some areas that are very interest rate sensitive, and you're really hurting those. And it's part of why I think the Fed can and should stop.